Are dividends actually irrelevant? Think about it. Should you be hunting for dividend-paying companies, or is it better to skip them entirely? Does a dividend check mean a business is rock solid and dependable, or is it a red flag that the company has officially run out of new ideas to grow?
Just a note to say that this video is for educational purposes only and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses.
Is that cash a steady source of income, or is it the last gasp of a company past its prime, like a star shining brightest right before it fades away? Today, we're digging into the facts to see which approach actually helps your portfolio shine. We've designed this video as part of a series to give you the essential market context you need to navigate today's world. While this isn't direct financial advice, it's the high-level background savvy investors use to sharpen their edge.
Let's start with the fundamentals. Dividends are simply payments companies make to their shareholders. Usually, you'll see these paid out once or twice a year. But here's the catch. Not every company plays along. The reliables, big utility companies or household brands often pay regular dividends. The growers, newer or fast-growing businesses usually hang on to every penny of profit to fund expansion instead of paying shareholders. There's a massive debate about whether dividends even matter. Some swear by them for stability. Others argue that companies that keep their profits grow faster and perform better. If you look at the classic Mount Rushmore of economic studies, Miller Modigliani, Bhattacharya, Littner, and Gordon, they generally point to dividends as a sign of reliability and stability. But there's a problem. Those studies are from the 1960s and 70s. In the modern investment world, that's practically prehistory. Recent evidence shows that the best strategy often depends on the market mood. In bull markets, companies that aggressively reinvest their profits tend to win because they can scale fast while capital is cheap. In bear markets, dividend-paying stocks often hold up better. That dividend acts as a yield cushion and signals that the company is a safe haven, whether that's actually true or just good PR. Of course, the million-dollar secret is knowing exactly when a bull market flips into a crash.
Historically, 40% of the S&P 500's total return has come from reinvested dividends. To put that in perspective, while the S&P has averaged about 10% annual growth, roughly 2% of that comes from dividends, while the other 8% comes from rising share prices.
Now for the boring but vital bit, taxes. Regular accounts. If you get dividends here, you usually pay tax on them every single year. Retirement accounts, like an IRA. You might not pay tax until you withdraw the money, or potentially never. For big portfolios, this one detail changes everything.
So what should you take away from this? Dividends aren't universal. Not every company pays them. Funds handle dividends differently. Some pay them out, others reinvest them for you. The theory says dividends are irrelevant in a vacuum. But in the real world, taxes and investor psychology make them a vital tool for managing risk. Dividends are just one piece of the puzzle. Now, let's hand it over to peer review Pete for a different perspective.
Thanks. My main gripe? You're using the word maybe a lot and not giving many firm conclusions. You're also quoting academic research that's old and might not apply to today's tech-driven markets. And those 40% and 2% stats, they mix bear and bull markets together, which can sometimes be misleading. I do appreciate that you admitted there are no clear rules. Dividend theory is definitely not settled yet.
Thanks, Pete. And thank you for watching. We've covered a lot, but dividends are just one of 30 critical topics every serious investor needs to master. If you want to fast-track your learning, I highly recommend our comprehensive guide on Amazon. The link is in the description. I'll see you in the next videos. The links to them are here.